Stop scrolling right now, because what is happening in the silver market today, on March 18th, 2026, is the kind of setup that serious traders only see once, maybe twice in a decade. And if you miss the next 15 minutes of this analysis, you could be walking away from one of the most explosive positioning opportunities the precious metals market has offered since the historic all-time high of £120.67 per ounce that silver hit just weeks ago on January 29th. We are not here for noise, we are not here for hype. This channel, Silver Signals, exists for one reason: to give you the real, unfiltered, institutional-grade analysis that the mainstream financial media will never hand you. So buckle in, this is your full deep dive, and it starts right now. My name is JIANG, and welcome back to Silver Signals. Today's date is March 18th, 2026, and the spot price for XAG USD is trading right now at approximately $80.25 per ounce, down roughly $1 from where we were earlier this week, sitting in a volatile consolidation zone after a parabolic run that shook the entire commodities world. And I want you to understand something clearly before we go any further. This pullback is not the story. The pullback is the setup. To understand where silver is right now, you have to understand where it has been, and more critically, why 2026 is fundamentally different from every previous silver spike in modern history. Think back to 1980, when silver hit approximately $50 per ounce in nominal terms, and inflation adjusted to today's dollars. That peak is estimated north of $200 per ounce. People called it a bubble. People called it manipulation. It was a brief, violent supply shock-driven event. Then think about 2011, the post-financial crisis surge that took silver to $49.51, driven by QE fears, dollar debasement anxiety, and a wave of retail speculation. That too cooled off. The bulls got flushed. The whales walked away with the money. Sound familiar? But here is what is categorically, structurally, fundamentally different about where we are in 2026. Both the 1980 and 2011 peaks were demand-side emotional events. They were fear trades, people running to silver because they were scared of the dollar, scared of inflation, scared of war. What we are seeing in 2026 is something else entirely. We are watching the intersection of a structural industrial demand revolution collide with a monetary fear premium at the same time. And that combination has never, in modern financial history, occurred simultaneously at this scale. The market broke through the 2011 highs, then it broke through the 1980 nominal highs, and when it touched $121.67 on January 29th, silver wasn't just making history. It was rewriting the rules of what this market is capable of. And that is the foundation on which every single analysis we do here at Silver Signals is built. Let's start with the monthly chart, because this is where the macro narrative lives. And you need to see the full picture before you zoom in on the noise. On the monthly time frame, XAG USD put in what I can only describe as a parabolic extension beginning in Q3 of 2025, accelerating violently through Q4 and into the January 2026 all-time high, with the monthly candles from August through January being among the most powerful bullish monthly closes in the history of this market. After the ATH print at $121.67, what followed was a textbook macro retracement, and we have now pulled back to the $79.75 to $84.24 range, which, when you overlay your Fibonacci retracement levels from the late 2024 swing low to the January 2026 peak, lands us almost precisely on the 0.618 Fibonacci level, the golden ratio, the most respected and most watched retracement level in all of technical analysis. That is not a coincidence. On the monthly chart, the higher time frame structure remains overwhelmingly bullish. We have a higher high, we have a higher low in formation, the 10-month EMA is curving upward, and monthly RSI, despite the parabolic run, has reset into a more sustainable range. The monthly volume profile shows that the consolidation we are currently in is sitting right on top of a massive high-volume node, meaning there is real institutional interest defending these price levels. The macro trend has not broken, not even close. What you're watching is not a reversal. You're watching the market breathe. Now let's drop down to the daily chart, where the weekly structure tells a more nuanced and more dangerous story. Dangerous in the best possible way, if you know how to read it. The daily chart shows that since the January ATH, silver has been carving a descending channel, a controlled, structured pullback with a series of lower highs and lower lows on the daily time frame, which is completely normal post-ATH behavior in momentum markets. What we are watching for on the daily is confirmation of a channel breakout. As of today, we are hovering just below the upper rail of that descending channel in the $80 to $84 zone, and a daily close above approximately $85 to $87 would signal a structural break of the corrective pattern and a potential resumption of the broader uptrend. Every Silver Signals viewer needs to have that $85 to $87 level marked on their platform right now. However, and I need you to hear this clearly. There's a significant warning level on the daily chart. The daily 200 EMA is sitting around the $76 to $78 area. And if the bulls fail to reclaim the channel resistance and we see a daily close below the recent swing low structure, price could wick aggressively down to test that 200 EMA. That is a stop-loss hunt zone, a calculated move by institutional players to sweep out the retail longs who entered on the breakout to new highs. Before repricing higher, the whales need liquidity and they get it from your stop losses. Before we go any further, if you haven't already, hit that like button right now, subscribe to Silver Signals if you are not already part of this community, and drop your price prediction in the comments because I read every single one. Tell me, do you think silver reclaims $100 before Q2 of 2026, or do we see a deeper flush first? Comment your trade below, and now let's keep building this analysis. Now, let's get surgical and drop down to the 15-minute chart. This is where your New York session entries live and where the real money gets made or lost in the short term. The 15-minute structure today is showing a clear intraday consolidation range between approximately $79.50 and $81.20, with multiple tests of the lower boundary throughout the Asian and London sessions, and buyers stepping in consistently around the $79.75 level, which, not coincidentally, aligns with a key horizontal support and an intraday volume shelf. For the New York Open, the playbook on the 15-minute chart is straightforward but requires patience and discipline. If price opens the New York cash session with a bullish reclaim above $81.20, confirmed by volume, that is your signal to watch for continuation toward the $83.50 to $84.25 resistance cluster, which is where the daily channel resistance lives on a compressed basis. On the other hand, if the New York Open brings selling pressure and we break below $79.50 with conviction, the next meaningful support is the $77.25 to $77.80 zone, the intraday Fibonacci 1.272 extension, and a prior consolidation base. Wicks are your friend if you understand their purpose, and every downside wick into that zone is potential accumulation in real time. The whales might be engineering a final liquidity sweep before pushing higher. That is exactly the kind of institutional move that Silver Signals exists to help you identify before it happens, not after. I want to issue a specific bull trap warning on the 15-minute for today's session. The fact that we are sitting just below a major resistance level after a prolonged corrective phase creates the perfect conditions for an engineered fake breakout, meaning price pokes above 84.20, triggers the retail FOMO buyers, and then reverses violently below the level, trapping longs and creating cascade selling. Do not chase breakouts in this environment without confirmation. Wait for a candle close, not a wick, because a wick does not confirm a breakout, a close confirms a breakout, and patience is a trading strategy. Now let's talk about why the macro story for silver in 2026 is unlike anything we have seen before, because the fundamentals here are not subtle. The Silver Institute's most recent data confirms what sophisticated traders have known for several quarters now. The global silver market is running a structural physical supply deficit, meaning we are consuming more silver industrially than we are pulling out of the ground and recycling back into the market. That imbalance has been growing year over year, and in 2025 it accelerated into territory that the market simply cannot ignore much longer. We are not talking about a speculative squeeze like 2021's retail frenzy. We are talking about a fundamental, multi-year supply-demand imbalance that does not resolve quickly. Every single price move we track on Silver Signals is being driven at its foundation by this structural reality. And now, layer on top of that what is happening in the AI and technology sector. Silver is not optional in the AI infrastructure build-out. It is not a nice to have. In every server farm, every data center, every advanced semiconductor fab, every next-generation cooling system relies on silver's unmatched electrical conductivity. The explosion of AI investment that accelerated through 2025 and is continuing into 2026 is creating an entirely new demand vector for silver that did not exist at any prior price peak. When silver hit $50 in 1980, there was no global AI infrastructure build-out consuming thousands of metric tons of silver annually. And when it hit $49 in 2011, that demand was in its infancy. Today, it is a fully formed, accelerating industrial reality. That is one of the core reasons why Silver Signals has been so consistent in its bullish macro thesis throughout this entire move. Then you add solar energy demand. The photovoltaic industry is the single largest industrial consumer of silver on Earth, and global solar installation targets for 2026 and beyond are staggering. Every solar panel, every single one, uses silver paste in its photovoltaic cells, and as nations accelerate their renewable energy transitions and utility-scale solar farms continue to be commissioned at record pace across North America, Europe, Southeast Asia, and the Middle East, the demand for silver from this sector alone is projected to consume an even greater share of annual mine supply. The math is not complicated. More solar means more silver needed, tighter supply, and higher prices. And that equation is not going to reverse anytime soon. When you combine the solar demand trajectory with the AI infrastructure build-out, you already have two historically unprecedented industrial demand drivers pressing simultaneously against a structurally constrained supply base. And let's not forget electric vehicles. The average EV uses significantly more silver than an internal combustion vehicle, from the battery management systems to the charging infrastructure to the advanced electronics. As EV adoption crosses critical mass thresholds in the USA, China, and Europe, silver demand from the automotive sector is compounding on top of the AI and solar demand. You have three massive, secular, irreversible industrial demand drivers all expanding simultaneously against a supply base that is structurally constrained by declining ore grades, permitting delays, and years of underinvestment in new mining capacity. Now let's layer in the macro financial environment. Because XAG USD does not exist in a vacuum, the DXY, the US dollar index, is the primary inverse correlator for silver in the short to medium term, and a weakening dollar lifts silver in dollar terms. As of this week, the DXY has been showing signs of fatigue after a multi-month stabilization phase, and any fresh weakness in the dollar, driven by deteriorating confidence in US fiscal sustainability, renewed Fed pivot expectations, or geopolitical risk-off flows, directly benefits the silver price. The Federal Reserve's posture remains critically important to this analysis. The latest CPI data out of the United States has remained stubbornly above the Fed's 2% target, creating what institutional desks are calling a stagflationary pressure environment, which is rising prices without corresponding economic growth. This is historically one of the most bullish macro setups possible for silver, because silver functions simultaneously as an inflation hedge and as an industrial commodity. The Fed is caught between hiking to fight inflation, which could slow growth, or holding and letting inflation run, which fuels the monetary premium in silver, and either path has a bullish component for this metal. Global central banks have also been actively accumulating precious metals reserves at a pace not seen since the Bretton Woods era. And while gold gets most of the headlines, the downstream effect on silver as institutional and sovereign wealth fund managers rotate into the broader precious metals complex is real and measurable in the order flow data. The paper-to-physical ratio in the silver market remains historically stretched, meaning that for every ounce of silver traded on paper in the futures markets, the corresponding physical backing is dangerously thin, and any significant rush to take physical delivery could send the spot price into a vertical move that would make January's ATH look like a warm-up. Let's talk about whale behavior and institutional positioning. Because understanding who is on the other side of your trade is not optional if you want to survive in this market. The Commitment of Traders report, the COT data, is your window into what the large speculators and commercial hedgers are doing with their positions. And what the COT data has been telling us through this corrective phase is that commercial hedgers, the smart money, the miners and refiners who know the physical market better than anyone, have been reducing their short positions at these levels. When the commercial shorts are covering, they are signaling that they do not believe prices are going substantially lower. That is not a buy signal on its own, but combined with everything else we have discussed today, it is a meaningful data point. The informed trader watches the COT data every single week, and silver signals will always flag the key shifts for you. But I also need to warn you about the liquidation hunt scenario that is absolutely on the table right now. The institutional players, the whales who move millions of ounces with a single order, are acutely aware of where the retail stop losses are clustered, and they are clustered just below the $77.50 area, the last significant intraday swing low that most retail traders used as their stop reference on the most recent bounce, and a coordinated move to sweep that liquidity pool, taking price down sharply to trigger those stops and flooding the market with forced sell orders before a violent reversal higher would be entirely consistent with institutional playbook behavior in this market structure. Do not set your stops at the obvious levels. Give your positions room, or you will be the liquidity that the whales feed on. This is precisely why Silver Signals exists, to show you the full institutional picture, not just the candlestick patterns that every beginner is trading off of. The market respects levels, it respects structure, but it also hunts stops, runs liquidity, and punishes the impatient. And the traders who navigate 2026 successfully in silver will be the ones who understand that this is not a simple buy-the-dip situation. It is a high-stakes chess match against some of the most sophisticated capital allocators on Earth, and your job is to stay on the right side of their moves. So what does the forward outlook look like from here? On the macro time frame, the case for silver reclaiming and ultimately surpassing the 121.67 all-time high remains intact as long as we hold above the critical macro support at $72 to $75. That zone represents the prior breakout base, the monthly 10 EMA, and the Fibonacci 0.786 retracement of the entire 2025 to 2026 rally. A monthly close below $72 would be the first serious structural warning signal that the bull trend is in jeopardy. Until that happens, and I do not currently expect it to, every dip is a potential opportunity for the informed, patient, position-building trader. The bull thesis on silver signals has not changed, and the structural backdrop continues to support it at every level of analysis. In the nearer term, over the next 4 to 8 weeks, the scenario I'm watching most closely is a retest of the $95 to $100 psychological resistance zone, which carries massive significance as round number resistance, aligning with prior consolidation zones from the parabolic advance and representing the first serious volume-based test of the bull thesis on the way back up. If silver can trade convincingly above $100 on a weekly closing basis, the door opens for a measured move back toward the ATH and potentially beyond it into price discovery territory above $121. The fundamental backdrop I described, the structural deficit, the AI demand, the solar surge, the EV build-out, the central bank accumulation, the inflationary macro environment, all of that underpins a multi-year thesis that is very much alive. Every Silver Signal subscriber who is positioned with patience and proper risk management is sitting in an extraordinary place right now. What would invalidate the bull thesis? I want to be honest with you. I always am on Silver Signals. A sharp and unexpected deflationary shock, a sudden severe demand destruction event in the industrial economy, or a dramatic and sustained Federal Reserve hiking cycle that crushes both inflation expectations and industrial activity simultaneously could create significant near-term headwinds. However, even in that scenario, the structural supply deficit does not disappear. It just gets temporarily overshadowed. The fundamental floor keeps rising, miners are not bringing on new capacity fast enough, the deficit grows, and eventually, price reflects reality. Here is what I want you to take away from everything we have covered today on Silver Signals. Silver at $80 per ounce on March 18th, 2026 is not the same as silver at $80 per ounce at any prior point in history, because the demand structure is fundamentally different, the supply constraints are fundamentally different, and the macro financial environment, inflation, dollar credibility, central bank behavior is fundamentally different. You're not simply watching a commodity bounce around in a range. You are watching a structural repricing of one of the most critical industrial and monetary metals on Earth in real time. The monthly trend is your macro anchor, bullish. The daily structure is your tactical guide. Watch that descending channel resistance at $85 to $87 for the breakout confirmation. And the 15-minute chart is your execution tool with your New York session range at $79.50 to $81.20 and the critical stop hunt zone below 70.50 that you need on your radar at all times. The fundamentals are the wind at silver's back, the structural deficit, the AI boom, the solar surge, the EV expansion, the inflationary macro backdrop, and the institutional players, the whales, are positioning. So the question is whether you are going to be informed enough, patient enough, and disciplined enough to position with them. That is what we are here to do together. That is what Silver Signals is built for. Not hot takes, not hype. Real analysis, real structure, real risk management, every single video. And if you found this deep dive valuable, if you walked away from this with information and perspective that genuinely improves how you think about this market, then please hit the like button right now, subscribe to Silver Signals if you haven't already, and drop your prediction in the comments. Does silver hit $100 before June 2026, or do we see one more flush to the low 70s first? Stay sharp, stay patient, stay disciplined. The market rewards the prepared. I am JIANG, this is Silver Signals, and I will see you in the next one.